Hi there, it's Friday the 17th of January 2020. I'm Steve Towers. Welcome to ITB, coming to you today from Bangalore. Let's get started. In regard to the France-US dispute concerning the French DST, there have been no significant public developments this week, but Finance Minister Le Maire and Treasury Secretary Mnuchin have been busy trying to reach a compromise agreement before the Davos World Economic Forum meeting, which starts on Tuesday. Meanwhile, in Norway, the country's finance minister has stated that if the OECD digitalisation project fails to find a solution in 2020, Norway will introduce a digital services tax. In regard to Pillars 1 and 2, I have 2 points to note. Firstly, at a conference in Berlin this week, Pascal Saint-Amans said that the US safe harbour proposal for Pillar 1 does not have support amongst the membership of the Inclusive Framework. And secondly, the Inclusive Framework members are scheduled to meet at the end of this month to discuss the 2 pillars. As expected, the China-US Phase 1 trade agreement was signed this week. For a copy of the agreement and a short fact sheet, please go to our website or app. The agreement requires China to significantly increase its purchases of US agricultural products, manufactured goods, business services, and oil and natural gas by $200 billion over 2020 and 2021. As reported in the Wall Street Journal, can China absorb that much from the US? And if so, can the US deliver? The two governments answer in the affirmative to both questions. But trade experts say the targets for 2020 and 2021 are so ambitious that they could stretch the capacity of even the world's 2 largest economies. According to the journal's analysis, the requirements amount to an increase of around 60% in what would be an unprecedented jump in bilateral trade. The US has recently moved forward in regard to 2 other significant trade matters. The USMCA, which is intended to replace NAFTA, has been approved by the US Senate by a large majority, and 2 trade agreements with Japan have entered into effect. In India, the Mumbai Income Tax Appellate Tribunal has decided a case in regard to Article 12, the Royalties and Fees for Included Services article in the India-US Treaty. The taxpayer is a US resident company. It carries on the business of staffing and recruitment outside India, and it has no PE in India. The US company entered into 2 agreements with a related Indian company, a service agreement and a royalty agreement. Fees were paid by the Indian company under the 2 agreements. It was accepted that the fees paid under the royalty agreement fell within the definition of royalties in Article 12. However, the issue in the case was whether the fees paid under the service agreement were caught by the definition of fees for included services, also in Article 12. Under the royalty agreement, the Indian company was provided with the right to use trademarks, know-how, for example, trade secrets, industry knowledge, competitor and customer information, best practices, service delivery process, etc., testing and training software, and the Kelly Quality Management System. And under the service agreement, the US company provided a range of management services, including advice and support on strategic planning, expansion of customer base, internal controls, HR systems, legal and tax issues, insurance, risk, pricing, and so on. As I said, the fees paid under the royalty agreement were accepted as falling within the definition of royalties in Article 12 of the treaty. The relevant part of the definition of fees for included services in Article 12.4 is this: means payments of any kind to any person in consideration for the rendering of any technical or consultancy services, including through the provision of technical or other personnel, if such services A, are ancillary and subsidiary to the application or enjoyment of the right, property or information for which a payment which falls within the definition of royalties in Article 12 is received. To fall within this definition, the technical or consultancy services must be ancillary and subsidiary to the application or enjoyment of the items for which royalties are paid, not independent of such items, and I would think not even complementary with such items, but ancillary and subsidiary to such items. That distinction was key in this case. The tribunal said this: the services in question in this case are independent services on a standalone basis, and as such, Article 12.4a does not come into play. And therefore, the tribunal held that the fees paid under the service agreement did not fall within the definition of fees for included services. For a copy of this case, please go to our website or app. In Korea, the 2020 tax reform has been enacted into law and is generally effective from the 1st of January 2020. I described the highlights of the tax reform package when it was released by the government in mid-2019. And what's particularly interesting is that the new law contains two provisions which are aimed at effectively allowing domestic tax law to expand the scope of existing treaties. The first of these provisions seeks to impose royalty withholding tax on treaty-covered outbound payments for the supposed use in Korea of patents which are registered outside Korea. I say supposed use because a foreign registered patent provides no legal rights in Korea. The government has tried to achieve this outcome in regard to the Korea-US treaty for over 10 years, but it has been unsuccessful in Supreme Court cases on the point. You'll remember that the most recent unsuccessful case concerned Samsung in early 2019. In this latest attempt, the domestic law provision will deem the payments to be for the use of other like property or rights, which is a phrase used in the definition of royalties in the Korea-US treaty. And the second provision seeks to impose a 16.5% withholding tax on treaty-covered outbound compensation payments for infringement of a patent which is registered outside of Korea, but which is again supposedly used in Korea. The provision classifies such payments as other income for both domestic tax and treaty purposes. The government's intention is that the withholding tax would be applicable in two treaty situations. Firstly, for those treaties which don't have an other income article, such as the Korea-US treaty. And secondly, for those treaties which do have an other income article, but which include a provision based on Article 21.3 of the UN Model Treaty, such as the Korea-Singapore Treaty. For all other treaties, imposition of the withholding tax would, I expect, be prevented by the treaty. In Malaysia, the tax authorities have issued 6 items of guidance in regard to service tax. Each item of guidance is called a service tax policy. For a copy of these 6 documents, please go to our website or app. Also in Malaysia, the government has announced some changes to the non-deductibility rules for payments made to Labuan companies. The changes are taxpayer friendly and have been made effective from the 1st of January 2019. For a copy of the announcement, please go to our website or app. In Singapore, a new corporate vehicle, the Variable Capital Company, or VCC, has been launched by government authorities. According to a press release issued by the government authorities, the VCC can be used for a wide range of investment funds and provides fund managers with greater operational flexibility and cost savings. It will encourage more funds to be domiciled in Singapore. For a copy of the press release, please go to our website or app. In Taiwan, the government has issued regulations on a reduction in the retained earnings tax to encourage companies to make substantial investments. Under the new rules, qualifying capital expenditure, which is incurred within a period of 3 years, can be deducted from the tax base for the 5% retained earnings tax. For a copy of the regulations, please go to our website or app. The European Commission has published a presentation on the future trade relationship between the EU and the UK in the expectation that Brexit will occur on the 31st of January. The presentation outlines the issues to be considered when the EU and UK negotiate a free trade agreement. For a copy of the presentation, please go to our website or app. The European Commission has also published a progress report on the implementation of the Union Customs Code, which entered into force in 2016. For a copy of the report, please go to our website or app. And in addition, the European Commission has invited public comments on draft amendments to the state aid guidelines for the EU emission trading system. Public comments are requested by the 10th of March. For a copy of the Commission's press release on this topic, please go to our website or app. In the Netherlands, the Supreme Court has decided a case in regard to the applicability of a domestic law anti-abuse rule in a dividend withholding tax situation. Let's start on the left. Before 2010, a Swiss resident individual indirectly owned 100% of the shares in the taxpayer company, which at that time was resident in the Netherlands. The Swiss resident individual also owned A-class shares in a Netherlands resident holding company, which I call Holdco. B-class shares in Holdco were owned by the taxpayer company. The B-class shares constituted less than 25% of the share capital of Holdco. Now, if you look at the right side, in 2010, the Swiss resident individual sold his A-class shares to the taxpayer company, which resulted in the taxpayer company owning both the A and B shares, which together constituted at least 25% of the share capital of Holdco. Now, back to the left. In 2011, the place of management of the taxpayer company was transferred to Luxembourg, which had the effect of making the taxpayer company resident in Luxembourg and not the Netherlands. And then on the right side, in 2012, Holdco paid a large dividend to the taxpayer company. At the time of the dividend payment, the court described the taxpayer company as a cash flow company, meaning that the A and B shares were held as an investment, not as a business asset. Also at that time, the taxpayer company had no office space and no employees. It was described by the lower court as having no substance. Prima facie, the dividend would be exempt from Dutch dividend withholding tax under the legislation which transposes the EU Parent Subsidiary Directive. However, the issue in the case was whether an anti-abuse rule in the Dutch legislation, Article 17.3b, applied to deny that exemption. Article 17.3b applies if both a purpose test and a business test are satisfied. The lower court held that on the facts of this case, both tests were satisfied, and therefore Article 17.3b denied the exemption from dividend withholding tax. The Supreme Court agreed with that conclusion. The Supreme Court also held that Article 17.3b did not breach either the Parent Subsidiary Directive or the EU Freedom of Establishment for two reasons. The tests correspond with the wholly artificial arrangements principle laid down by the European Court of Justice in the Cadbury-Schweppes case. And the burden of proof is on the tax authorities to show evidence which supports the satisfaction of both tests, and then the taxpayer has a right of rebuttal. And so the exemption was not allowed. However, in an interesting twist, the court held that the taxpayer company could claim the benefit of the Luxembourg-Netherlands Treaty. And so the Dutch dividend withholding tax rate was limited to 2.5% under Article 10 of that treaty. For a copy of this case, please go to our website or app. Norway has introduced a new GAR, effective the 1st of January 2020. For a copy of the new GAR, please go to our website or app. In the UK, the government's proposed financial bailout of the Flybe airline, which apparently involves some deferral of tax payments, has been referred to the European Commission by the owner of British Airways as illegal state aid. In Nigeria, the Attorney General has withdrawn its $2 billion tax claim against MTN, the large South African telecom company. MTN has issued a press release which indicates that, as well as withdrawing its claim, the Attorney General has referred the matter to the Nigerian tax authorities for resolution of the issues, which doesn't sound like a final conclusion. For a copy of MTN's press release, please go to our website or app. Also in Nigeria, the Finance Bill 2019 has been enacted into law. I described the highlights of the bill in ITB on the 15th of November. The provisions are generally effective from the 1st of January 2020, but there are two major exceptions. Firstly, the new income tax nexus rule in regard to significant economic presence requires the minister to define what is meant by significant economic presence. She has not yet done so. Of course, it's possible that when she does so, the new rule will then be effective from the 1st of January 2020. We'll see. But the minister has announced that the increase in the VAT rate from 5% to 7.5% will be effective on the 1st of February. In Uganda, government officials are publicly discussing the possible repeal of the controversial social media tax, which was introduced in 2018. The tax has so far produced far less revenue than originally expected, apparently due to widespread evasion. In the UAE, the tax authorities have published updated VAT guidance on so-called special methods for input tax apportionment. For a copy of the updated guidance, please go to our website or app. Also in the UAE, the Ministry of Finance has published guidance in the form of frequently asked questions on the country's economic substance regulations. For a copy of the guidance, please go to our website or app. In Bermuda, significant changes have been made to the territory's economic substance rules, following discussions with the EU and the OECD. For a copy of the relevant changes, please go to our website or app. In Ecuador, the tax reform bill has finally become law, effective generally the 1st of January 2020. An earlier version of the bill was rejected by Parliament. Let me run through the major tax changes in the final law. For companies outside the financial sector, a restriction on deductibility of interest set at 20% of EBITDA will be introduced. A temporary additional tax will be imposed on companies with annual gross revenue exceeding $1 million. Importantly, the tax will be imposed on gross revenue, not on taxable profits. The tax rate will range between 0.1% and 0.2%, but the additional tax will be capped at 25% of the company's tax liability for the 2018 year. The additional tax will apply only in 2020, 2021 and 2022. A dividend withholding tax at an effective rate of 10% has been introduced on dividends paid by resident companies to non-resident companies. Under previous law, such dividends were generally exempt from withholding tax. And VAT will now be imposed on inbound digital services at the standard 12% rate. Credit card companies will act as withholding agents to collect the tax. In Mexico, the Ministry of Finance has released guidance in regard to the income tax and VAT withholding obligations of operators of digital platforms, as introduced by the 2020 Budget Act. For a copy of the guidance, please go to our website or app. In the US, the Congressional Research Service has released a short report on the look-through treatment under Subpart F. For a copy of the report, please go to our website or app. And now for this week's treaty developments. We've had 1 treaty signed, 3 treaties enter into force, and 1 protocol enter into force. I have 2 articles for you this week. The first article is called Abuse of Law under EU Directives. It's written by Frederick Mulder and Yves Cattell, and it's published in the IBFD's Derivatives and Financial Instruments Journal. In this article, the authors discuss the so-called Danish joint cases, which were decided by the European Court of Justice in early 2019. Those cases concerned two related topics. Firstly, an unwritten anti-abuse rule under the EU Parent Subsidiary Directive and under the EU Interest and Royalties Directive. And secondly, the beneficial ownership test under the Interest and Royalties Directive. This article focuses on the first topic, the unwritten anti-abuse rule under the Parent Subsidiary Directive. At the start of the article, the authors write this: many tax professionals have perceived the ECJ decision as far-reaching and possibly in conflict with other case law of the ECJ. In this article, the authors argue that the decision is not that controversial and fits within the existing legal framework previously set out by the ECJ. This is very relevant for private equity investors making use of a European holding company, special purpose vehicle, or joint venture company with limited activities. And they conclude in this way: in the Danish cases, the recipient of the dividends had, besides receiving and paying dividends, no other economic activity. No local directors, no personnel, no premises and equipment, and no local management. There was very little time between receiving the dividends and paying them onwards, and the recipient retained only just enough from the spread between the incoming and outgoing dividends to finance the costs related to the holding activities. In light of these facts, the ECJ ruled that these economic operators have carried out purely formal or artificial transactions devoid of any economic and commercial justification, with the essential aim of benefiting improperly from the exemption from withholding tax. The authors argue that this is exactly in line with the abuse of law concept that was already defined by the ECJ back in 2006 in the Cadbury-Schweppes case, and therefore still subject to a restrictive interpretation. The authors argue that this would mean that even very little economic activity would be sufficient proof that there is no wholly artificial arrangement or not a conduit company under the Parent Subsidiary Directive. In other words, as the ECJ stated, there can be abuse only when the recipient's sole activity is the receipt of dividends and their transmission to the beneficial owner or to other conduit companies. The second article is called Cloud Computing: Difficulties in Applying Current and Proposed Nexus and Profit Allocation Rules in a Cross-Border Scenario. It's written by Dina Skornas and is published in the IBFD's Bulletin for International Taxation. To quote from the article's synopsis, this article discusses the international tax challenges with respect to business profits arising from the digital economy using the cloud computing service model. In particular, it examines issues that arise from the OECD Model Convention and other OECD documents, the EU proposal for a directive on a significant digital presence, and the OECD Secretariat proposal for a unified approach under Pillar 1. One important qualification is made by the author at the start of the article. Although the issue of characterization of payments relating to cloud computing transactions should not be neglected, in this article it is assumed that those transactions can generally be qualified as business profits, which might disappoint those readers who were expecting some discussion of characterization, particularly in light of the US proposed regulations which were issued in August. Well, that's the way it is this Friday, the 17th of January 2020. The ITB team will be having a well-earned one-week break to celebrate Chinese New Year. We'll be back full of life on Friday the 31st of January. Until then, I'd like to wish you all a very healthy and a very wealthy Year of the Rat. Gong Chi Fa Chai. And of course, have a great weekend.